Chris, something you mentioned in your research in the last couple of weeks, you said the bear market was over. Now, I have to say up front, you didn't say a rip-roaring bull market was about to begin, but you said the bear market was over. How does your equity market compete with a 5% 6-month T-bill, a 2-year at 4.90, a 10-year at 4%?
Yeah, it's very difficult to compete. At this point, you have if you look at the front end of the curve and you tack on some sort of IG or high yield spread, that's a pretty competitive rate of return. And so we're not all bulled up at this point in time. The reason for the note saying the bear market was over is you really shouldn't trade this like a bear market. You shouldn't expect the wheels to fall off the cart. You shouldn't be afraid to trade this market. Don't expect things to just collapse. That's not true. The underlying fundamentals are good enough. The credit markets are strong enough. And if you find good risk rewards, that's where you want to place your emphasis. But this is not the great bull market, the beginning of the great bull market. What this is finding really good risk rewards. Some of that is on the front end of the rate curve. Some of that is in mid-cap growth, and some of that is overseas.
Minneapolis Fed President Neil Kashkari said to me, it's much more important what we signal with the so-called dot plot, not whether we go 25 or 50. Chris, when they sit down at this Fed meeting later this month, they're going to have one extra payrolls report, March 10th, an extra CPI report, March 14th. Do you need to see both those things before you can draw any conclusions on what you can expect from the Fed later this month?
I think the Fed has been very clear. They want to get to 5%, maybe a little bit more than 5%, then they want to wait. Right? If that narrative changes, I think they take a hit to credibility. Some of the data has come in a bit stronger in recent weeks, but earlier this year, some of the data came in a bit weaker. And that's what you should expect. Right? The data should be mixed. I don't think there's enough in the data there's a lot of talk about, oh, can they go 50? I don't think they need to. What they need to do is exactly what they're saying. Get to in and around 5%. Wait. As any economist will tell you, there's long and variable lags to monetary policy and all these other issues. Inflation is slowly coming down, but grudgingly, right? And so now the question is, how long can you wait? We're in a good situation where the economy has not cracked, right? But you've taken speculation out of the market. Inflation is slowly coming down. You're normalizing rates, and you're in a pretty good spot. So you really don't have to rock the boat. Just continue to do what along your narrative, what you're talking about, that 5% level, in and around that 5% level, and then wait. And again, the data, I think, will be mixed going forward. It's not going to be one-sided. And ultimately, we're going to get to a lower level of inflation. But 2%, I think, is much more aspirational than anything else.